All right, welcome everyone. It's time we jump into another exclusive episode. This time we're going to be going over the portfolios. I'll be sharing some thoughts on them, both the passive income portfolio, the story fund, as well as my watch list. Companies that I'm looking at, what I'm looking for are compounding machines, and that's a very specific term, the way that I use it. So we're going to be looking over all of that. Plus, we're going to be doing an Ask Me Anything, where you can ask questions. I try to go over them. We'll be looking at the most recent questions we received, and I'll be going over my latest monthly update on the portfolio. I kind of want to talk through it, read over it, and just revisit it. So we have a lot to get into. Let's go ahead and jump in. First of all, if we look at the portfolio here, we can start off with the passive income portfolio. In fact, I think it would be best, instead of going into the portfolios, let's go into the fact sheet. Let's go into the monthly update. This is something that I give out every single month on the Discord, and it just shows my overall thoughts. The first thing I do is I outline my investing strategy. I haven't really updated this in a while because the portfolio strategy has remained the same. I look for exceedingly high quality companies and purchase them as large concentrated positions. I define the best businesses as ones that have dominant market positions, high barriers to entry, deeply entrenched brand names and distribution, cash-rich balance sheets, scalability and operating leverage, organic revenue growth through volume and pricing, and predictably high returns on R&D and CapEx. That's a lot to stuff into the criteria to find a company. That's why there's a lot of companies in the world, and there's only a couple that fit in with all of these criteria. There really is only a handful. I'm constantly trying to find new ones that fit, but this is very difficult to get. And most of the companies I own also don't fit all of this perfectly. They still have some weaknesses, but I try to get them as close as possible. These businesses are typically gatekeepers, monopolies, or toll booths. Apple with the App Store, the gatekeeper, kind of monopolistic. You have Google with Google Search. You have, toll booth companies like Visa and MasterCard. Those are the ones that are typically in my portfolio. They are typically the largest or second largest in their industry, and the returns are highly predictable and repeatable. Dominant market positions and typically the second largest or largest in their industry, I like to find the ones that are the largest in the industry. If I look at Amazon, they're the largest in cloud hosting. In cloud, they are the largest, and then they're the third largest in advertising. They're the largest in online retail. So they're the largest in many industries and second and third place in other important industries. You have MasterCard and Visa, the two largest in their industry. So I like these companies that are right, they own the market they compete in. You have Intuit. Intuit owns 80% of small businesses doing taxes and individuals doing taxes. They have, CRMs basically for small businesses to run their accounting. With QuickBooks, they are the largest in the industry by far. So I like those concentrated winners as well. So we look at the portfolio allocation. Right now we have S&P Global at the top. It's been okay. S&P Global hasn't been like a huge winner, but it's been a good one. It's, helped the portfolio gain. MasterCard has taken a breather because this judge is playing hardball with MasterCard and Visa, saying that they're going to have to pay more. So they're going to have to decide whether or not they bring that to court or not. Microsoft, Microsoft probably should be the top holding in my portfolio. Microsoft should be like a 15% holding. It's 10.5% right now, so it's not small, but this one could easily be 15%. Yeah, I would even feel fine putting Microsoft as like 20%. It has so many tailwinds. It's so diversified. It's such a good company. I think it might be the best company in the world. You have Costco as 10.46%. Costco is at that big percentage because of gains. I'm not adding to this one. I haven't bought Costco in years. I don't think I've bought any of it in like 2 years. Maybe I'm mistaken, but I haven't bought this one in a while. $41,000 of it is gains. That's a lot of gains. So this company, a lot of the holding position is gains. That's why it's going up. And I don't want to trim the flowers, right? I don't want to water the weeds and trim the flowers. So I'm letting Costco just go. A lot of people, they point out that Costco trades at a higher PE ratio than it did over its historical average. And they're right. It does. It trades at a much higher PE ratio than it did over its historical average. Now, I'm not suggesting that Costco deserves definitively to trade at a 46 forward PE, but what I am suggesting is that Costco certainly deserves to trade at a higher forward PE ratio, a higher multiple than it did 10 years ago. 10 years ago, Costco was a weaker company than it is today. It was a less predictable company than it is today. It had a lower retention rate. It had less international success. It had less brand value with Kirkland's signature. It had greater competitors and competitors that were more relevant threats like Sam's Club and BJ Wholesale. Costco is in a better position now strategically. It has more market dominance. It's a bigger winner now than it was 10 years ago. So again, I'm not suggesting that the multiple makes sense or that it deserves to trade at this multiple, but I am suggesting that the multiple does deserve to expand for companies that are becoming more predictable, that their earnings are more predictable, that their future is more certain. Costco has durability. Even looking at we look at the renewal rate, which is basically like a retention rate. We look 10, 15 years ago, and it was in the high 80s, and now it's the low 90s, from 87% to 93%. This is fundamentals increasing for the business over time, which means it's a better business today than it was 10 years ago. And the future is more promising today than it was 10 years ago. So Costco has gone up like crazy. I'm just letting it roll. I'm letting momentum take it. I realize right now what's being rewarded in this market, the companies that investors love right now, are high quality growth stocks. Quality growth. And that is exactly what my portfolio is. It's quality growth. So these type of companies, Costco's, Microsoft's, Apple, these type of growth quality companies are doing really well. And Costco is a growth company that's high quality, and it basically meets that category as perfectly as possible. So it's being really rewarded right now. Momentum can take stocks up way past where you think it's sensible. So in a lot of cases, I think if something's getting rewarded in your portfolio, quality and growth has a lot of momentum, I don't want to sell that momentum short, especially for a company where I view the future incredibly bright. Then we have Texas Roadhouse at 10.9%. I've shown this one before. It has almost $40,000 in gains. Texas Roadhouse is not the best company in my portfolio. It really isn't. It's not. By far, it's not the best. In fact, I'd consider it one of the weaker companies in my portfolio in terms of moat, market dominance, concentrated position, monopolistic, high returns on capital. It's good. It has predictably high returns on capital with new openings, but it doesn't have pricing power. It has good brand recognition, and I think it has a very good, it has kind of a moat through their already big chain and distribution. But overall, Texas Roadhouse is just not the strongest company in my portfolio, and it's risen to a large position. Now, how did that happen? Companies that aren't as good deserve lower valuations. They deserve to trade at lower multiples. And that's where I got into Texas Roadhouse. I bought this company when it was trading at around a 4.5% free cash flow yield, and it still had very good growth prospects. Texas Roadhouse was growing 16 to 20% earnings per share. A company that's trading really low, that's growing really fast, and I view the future of it really bright despite its characteristics of being highly competitive. I think are in good shape here. So I acknowledge that this is not the best company, but when you get into a good company, Texas Roadhouse, I think, is a compounding machine to some extent. We look at the metrics here, and it's been very convincingly growing. I mean, this is a very good growth profile for a company, very good growth profile for their earnings per share. I look at it, and there's not a lot of cyclicality. There's not a lot of mistakes. They have a very good balance sheet. So it's a good company, but even so, I feel like this one, it doesn't fit with the metrics as much as other ones do. So when I'm looking at my fact sheet and I'm looking at this description, Texas Roadhouse is not the one that fits perfectly with this, but it makes up for it in some ways. It does have a cash-rich balance sheet. It does not have scalability. It doesn't have much operating leverage, but it has a lot of organic revenue growth. They grow like crazy, and Texas Roadhouse is a true growth story. It's a company that's grown so big, and it's not even in the S&P 500 yet. So that one has been hugely accretive to my performance in this portfolio. It's been a big winner in the portfolio. I'm not looking to increase my stake of Texas Roadhouse like crazy, but I will continue to hold it unless I get solid data, solid reasoning that shows me I should take some gains off the table. Right now, the valuation, I think, is not as attractive. It's down to 2%, but 27 forward PE ratio. So right now it's on the edge, I think, of being fairly valued, not extreme overvalued, not extreme undervalued. But I think it's getting to the point where I don't want to add to this company, given that it's not my highest quality name in my portfolio. But for now, I'm going to continue to hold it. So you probably won't see any sells going through with Texas Roadhouse. I don't think I'm going to take gains yet. With Intuit, another just super high quality company. Intuit seems so much like at least my mental perception of the company was that it was like a boomer stock, just an old kind of stodgy, washed up company that does a product everybody hates, which is TurboTax. Everyone hates it, especially if you go into online forums. People, they'll wax poetic about how much they hate it and how evil the company is, yada, yada. When I looked into it, I realized that this is a very young-minded company. They have tons of developers working on creating new software. All of the software they're creating is cloud hosted. They partner with AWS. They're using the latest technology, integrating all of it with artificial intelligence. They're building out new user interfaces, competing with new CRMs. They're moving up vertically and horizontally. They have a concentrated dominant market share of important different software verticals. TurboTax is a huge one. It's basically the go-to small business. They control the market with over 80% share in it. With QuickBooks, not TurboTax. TurboTax is another one. So you have TurboTax, which is tax focused. You have QuickBooks, which is small business focused, and they have dominant market share in both of these. So Intuit's one that is really impressive to me. I realize why people don't invest in the company. It's not like, it's not a sexy company. It's no Palantir. It's no Tesla. It doesn't have the appeal. It doesn't have the personalities. There's no big Elon Musk personality tied to it, or Alex Karp, where you can look at the interviews and see how crazy the people are and eccentric they are leading it. But it's a company that's going to make a lot of money, and it will continue to grow its free cash flow per share, I think, well above 15% per year. It is an incredibly good tech company. Salesforce. Let's go ahead and jump into Salesforce for a minute. Whereas if we look at Intuit, we can stop by that one first and just take a peek at it. Intuit's right here with $21,000 in the green. Intuit, a lot of people say, Joseph, if he buys a company, it will go down a bit after he buys it. Not with all of them. Intuit was a company that when I bought it, immediately it just cruised upward with incredible momentum. I believe it was the fastest company I've ever invested in to make $10,000, or at least get $10,000 in the green. It was like within 2 months, it was up $10,000. I wasn't trying to trade the company, but I actually bought into it when Terry Smith was selling out, saying that the stock-based comp is a problem. I didn't think it was that big of a problem. I thought a lot of the stock-based comp was due to their acquisition. They own Credit Karma. They've done different acquisitions. But yeah, this one's doing okay. $21,000 in the green. Intuit, I'm still investing in. Still going to hold it. You're not going to see any sales come through for Intuit. If we stop by and look at Salesforce, this is one that went the other direction. I invested in it, and immediately the next earnings report, investors didn't like it. Now, I'll call it how it is with an earnings report. If a company performs poorly and the stock goes down, that makes sense. If it's under investors' expectations. But with Salesforce, they beat almost every metric and exactly what investors were asking for just the previous months. Investors were asking for Salesforce to become more cautious about spending, to not do any large-scale acquisitions, to generate a growing amount of free cash flow and free cash flow per share. Salesforce did all of that. They did $6 billion in free cash flow, an incredible amount. They controlled their expenses. They had expenses go down. The margins were going up for the company. They did everything that investors wanted, and the stock still got punished because they didn't have as great of an AI story. And this shows the kind of craziness of the market, how much it can change what it wants over a 3-month period. When I looked at it, I just thought that Salesforce is really delivering. Like Mark Benioff, in charge of Salesforce, is really giving what investors said they wanted 6 months ago, which was growing free cash flow. They wanted Salesforce to grow up, to really generate growing amounts of real true free cash flow, and they did that. So I didn't see it as such a bad thing. The stock went down, I believe, around $10,000. So it went minus $10,000. This is Salesforce. And right now it's minus $3,000. So we've recovered most of our loss here. This stock is almost even. When you're looking at a $53,000 position and it's $3,000 in the red, it's red, but it looks a little bit more even now. It's no longer like a big blunder or a big loss. And part of the reason why is because I bought more Salesforce during the dip. That really helped out the performance. I use that as an opportunity. Salesforce bumped up around 15%. We have Apple, the same thing, a little bit of slowing growth. I'm a little bit more hesitant with Apple. I realize people are excited about the AI, but it's one where I'm good with it being 6% of my portfolio. Moody's, same as ever. Chipotle's, they're just crushing it. The valuation's super high, so I'm not buying it right now. Chipotle is one that I've considered taking gains in. I've made so much money so fast with that company, and the valuation's so high that it's one that I've considered taking gains in. I haven't done it yet, but I'm probably closest to taking gains in Chipotle than any other company. Canadian Pacific and Vici, same story with those. When we look at the performance here, we can dive into the performance numbers. We have the passive income portfolio against the S&P 500 going back the past 2 years. It beat it in 2022. It beat it again by a large extent in 2023. We had a great 2023. A lot of that was my overweighting big tech, having Texas Roadhouse in it and Chipotle really helped out. Buying into Intuit at the right time. Even MasterCard and S&P Global, I bought into those ones at decent times. So that really helped out the performance, and we beat the S&P 500 by a decent amount. This year, I'm trailing the S&P 500 by around 4 or 5%. So we're up 11.35%. The S&P 500 is up 16.67%. Now, we're halfway through the year. I don't like being behind at all for any time period. I'm going to try to do some things that I think will amplify the performance. But the reality is here that a couple stocks are surging over the past couple of months that I don't have in my portfolio. What stock has done really well year to date? We had NVIDIA up like 125%. Around 4% of the S&P 500's performance, 4 to 5%, is just due to NVIDIA. So NVIDIA has surged forward. My portfolio has really good stocks. It's gone up this year, but it hasn't beat the S&P 500. Another one that I think has done well is Meta. I don't have Meta in my portfolio. And then frankly, I look at this year's performance, and a lot of the stocks this year that are doing really well that are not in the passive income portfolio are in the story fund. They're just stocks I have in the story fund. Like I probably would have Google in the passive income portfolio, but I already own so much of it in the story fund, and Amazon and Netflix. Those stocks have crushed it. The story fund, if I look at the performance of the story fund this year, just to give you an idea of how good this one has done, the performance has been astonishing. It's up 32% year to date. So the story fund, it's up big time this year, 32% compared to the passive income portfolio's 11%. And that's because Amazon, Netflix, Microsoft, Google, all of those have surged. And Amazon is 40% of the story fund. Netflix is 35%. So huge performance by those two companies. But I'm not making excuses here. I don't mind the performance. I think that NVIDIA is not going to rise forever. It's highly volatile. And as it grows in its total revenue, the year-over-year comparisons of revenue growth become exceedingly more difficult to beat. And NVIDIA is not going to continue growing how it is. It's just not. It can't. It's not going to double revenue again and again and again. Stocks don't grow to the skies. This company's trading at an incredibly high valuation. I would be more concerned about NVIDIA's valuation than any company in my portfolio by far. Trading at 40 times revenue, 40 times its earnings per share for a company where the fundamentals of it have been historically unpredictable and volatile and cyclical. That would be a concerning situation to be in. So I feel very good being positioned without having NVIDIA, without having Tesla in the portfolio. Tesla has floundered this year. It's had a big recovery, so the year to date doesn't look as bad, but there's not much supporting that. There's not much free cash flow supporting that. So I feel good with the weighting I have. I think the companies that I own will continue to grow on pace 10 to 15% per year in their free cash flow per share. The ones that I'm leaving out of my portfolio that aren't in the story fund, Nvidia and Tesla, I think are going to have a much more difficult time. Tesla's not growing their revenue. A lot of people, in fact, it's reminiscent to me. I see what's happening with Nvidia right now as like what happened to Tesla in 2021. In 2021, I was told over and over again, this is me just being proven wrong about Tesla. Right here, there's people saying that it's going to go up forever, you're missing out, all of that type of stuff. When I'm thinking, it's just at a valuation that doesn't make sense under any conditions. They'd have to solve full self-driving tomorrow and make it work with a robo-taxi that's highly profitable, right? All these things that might happen have to happen right now to justify the valuation of Tesla being worth over $1.2 trillion. A company that doesn't generate that much free cash flow. And since that point, the weight of the market, the weighing machine has caught up to the voting machine. Right here, we had the voting machine, and this period is the weighing machine coming into play. We've had 3 years of it just floundering and doing nothing. And I think, I'm not predicting for sure, but I think there's a chance that we'll see a similar pattern with Nvidia. It goes up 160%. You see these epic booms. This is where people say that it just is never going to go down, and you're missing the big picture here, and all this stuff. And then you're going to have multiple years of it doing nothing because the weighing machine will eventually start to fit in. You have a company trading at a 54 PE, a price to sales of 40 for this stock, a 1% free cash flow yield. These valuations are extreme, and investors are predicting incredible amounts of continued growth beyond today, which I think is going to become increasingly difficult. So when I look at my performance and the weightings, what I look at are companies that I have a very reasonable prediction that they're going to continue growing predictably. And then what I'm omitting from my portfolio are companies that I think are the most likely to have difficulty for the next 3 or 4 years. That's how I weight these positions. That's how I'm investing. That's how I think I'll continue to beat the benchmarks in both portfolios. When I look at the story fund, I know we don't have the performance here, but we can look at it. I can bring up the other performance chart here for the story fund. Let's take a look. Let me open it up here. The story fund is the same thing. The more I focused on companies that will have predictably high amounts of free cash flow per share growth, the better this portfolio has done. And if you look at it now, let me bring it up here. Yeah, we got it right here. We are $83,000 in the green on this. Most of this has been just this year. That's year to date. So that's not the full year. It's 31% money weighted returns this year, just year to date. It was basically flat going into this year, or not flat, but we were in the red going into this year. But since these companies have done so well this year, it's gone up to $83,000 in the green. So now we're up 78% overall, $82,000. If we look at the performance here, the story fund underperforming for a time and having this huge recovery. Now we have some margin above the S&P 500. I think that the story fund will continue to do well because I think these two companies will continue to do well. The two companies that are different than the index. We have Amazon and Netflix these are very different positions in the index because the index has Amazon weighted at like 5 or 6% weighting. So that's the index. This is weighted 35%. Overweighting a company that outperforms the rest of the index is a way to beat the index. So I think that will continue to happen. Netflix, I think, will continue to be a very prosperous company. I don't know exactly the multiple it will trade at, but I know that with the free cash flow growth I'm expecting, that it should trade at a much higher multiple than the rest of the market. So these ones have done well. I have a little bit more margin here. The story fund is just crushing it this year. It had a rough 2022, but 2023 and 2024 have been amazing. Even when I look back 1 year on the story fund, it's just gone straight up, and I haven't added any money to that portfolio. So overall, I'm happy with the performance. There is an alternate reality. Maybe Nvidia does go up and it just doubles and doubles and doubles again. And the whole market is pulled up by Nvidia. If that happens, this year I'm not going to beat the S&P 500. So that could happen. Don't want to say that Nvidia is going to go down. I can't make any guarantees. If Elon Musk finally solves full self-driving and they print $1 trillion in free cash flow, like many of the Tesla analysts say they're going to, and Tesla just goes up to multiple trillions of dollars and it pulls up the index, that will also relatively hurt my performance. So that there's a chance that could happen. Now, if Nvidia flounders and it even goes down a bit, or Tesla flounders more, and my portfolios continue to compound, they'll continue to outperform the rest of the market like they have the past 2 years. So we'll see how this entire year shakes out. But so far, it's a close race. It's a very close race in the passive income portfolio. It's not close at all in the story fund. The story fund is crushing both the S&P 500 and the QQQ in 2024. The recent trades I did. I added this section in new because I thought it was actually more interesting than, I think I would like to know people's recent trades and what they're kind of buying and stuff summarized. So I did it as a percentage of the portfolio, and the percentages are a big difference. So you can see here that I added a little bit to Canadian Pacific, a little bit to Moody's, only 0.2%, and a little bit to Vici. Small buys, and then I gave you the average price that I bought them. And then the big buy here was Salesforce. I bought 2%. That's a big chunk of the portfolio. 2% is a lot. And I bought that at 221. That was during the dip right after it sold off. You saw those buys come through, a couple thousand here, like 2,000 here. I kept adding to it because I just think it was an opportunity, and it's recovered a little bit since then. But that summarized the recent trading, and I'll continue to do this month by month. I'll show you what my recent trading has been. Now, yeah, we have the current value, the current gain, the number of holdings, the free cash flow yield, and so on. Let's jump into the commentary here. Year to date, the passive income portfolio still lags behind the S&P 500, but has outperformed SPY over the trailing 12 months. It has. So year to date, we're behind the S&P 500 in the passive income portfolio. Trailing 12 months, we're beating it. So it's just the past couple of months where the market has surged by a couple of companies. I don't think that's going to be sustained. To be clear, the central goal of my portfolio is to find companies that can predictably grow their free cash flow per share at a faster rate than the average of the weighted index. For example, according to Bloomberg, the S&P 500 grows its free cash flow per share on average by 8% per year. So free cash flow per share, that is like the ultimate economic indicator I look at for a company. The ultimate KPI that I look at is the free cash flow per share, and that's what I'm trying to predict will grow a lot with my companies. For the average of the S&P 500, when you take all of the companies, when you weight them out by their weighting, according to Bloomberg, over the past 10 years, it's grown 8% per year. Some years it grows a lot, so you have some years where it grows 20%, some years not so much, but 8% is the average over the past decade. I want to own a diversified collection of companies that can grow their free cash flow per share around 15% per year. And most importantly, do that for a long period of time with a level of predictability. Companies that grow their free cash flow per share by around double the rate of the market almost always outperform the market over a 5-year period. So, if you can find a company that will grow its free cash flow per share at roughly double the rate of the market, so double 8 is 16, 15 is close enough, nice round number there. But if you grow 15% per year, you're going to compound incredibly fast. And even if the starting price of the company is a little high, the growth makes up for it. It doesn't really matter how much you pay if the company outgrows that starting price, unless it's there's some cases where the price you pay is just way too much for any type of eventuality. But in most cases, from what I've seen, aside from investing right at the peak of the dot-com bubble, in almost every scenario, if a company grows its free cash flow for 15% per year for around 5 years, it usually outperforms the market. And it almost always is in the green. Even if it was expensive at the beginning of that timeline, if it grows 15% per year, it'll almost always outperform the market. Currently, I feel that each of my companies are on track to generate above market free cash flow per share growth. I'm adding to companies that I think are the cheapest relative to their future growth, primarily Salesforce currently. Since I purchased Salesforce dip, the stock has already rallied 17%, 221. That was my big buy. to 260. So that helped out. I went into the stock, traded down, I bought more of it, and it's bumped back up. That's helped out the returns on it. The end of July is when we get into the next earnings season. For this reason, I will save up a little cash between now and then and deploy if one of my holdings sells off due to earnings. Some of the best purchases I've made are post-earnings sell-offs on compounding machines. So right now, I'm not jumping in and making buy after buy in my portfolio. Even though I have some dividends, we got paid a Vici dividend and a few other dividends here. So I have $800 in dividends, but I'm not spending it right now. I'm going to continue to just put some money into the portfolio and have it go to the buying power, have it go to cash. And then I'm going to wait until the end of this month when we get into earnings season, when companies start reporting their earnings, and see if I can get any good sell-off on one of my stocks that I feel very strongly about. If that happens, I'll just deploy the money into that one. And if we don't get any sell-off on any company in my portfolio, I'll revert back to just dollar cost averaging into the one that I think is the best value. So there's some thoughts on the market, my portfolio relative to other stocks in the index. You know, the goal here is to outperform the S&P 500 and the QQQ, to do it with the both portfolios. I want to have them do really well and to compound at an attractive rate. I think so far this has been happening. It's been going really well. Now let's go ahead and move over. Let's get into some Ask Me Anything. These are questions that you ask. There's a channel at the bottom of the Discord where you can write in a question and I'll try to answer as best I can. Obviously, none of this is tailored investment advice. I don't know about your situations. I really don't. So I'm not going to give you advice on what to do with your life because I don't know your income, your education, your age, your risk tolerance, and all of that stuff. So, but I will answer questions on different topics and give my thoughts on things. Good evening, Joseph. You said you feel like you didn't miss the train on NVIDIA because it's too cyclical and subject to boom and bust periods. Albeit that is true, you say that you're a fundamental value investor and not a short-term trader. So I would think you wouldn't be reluctant to hold a company like NVIDIA through those boom and bust cycles if it meant you'd be up 25,000% in 10 years, which is astonishingly higher amount than any company you own. Also, in the same video, you say that NVIDIA has a very high margins and that this is one of the reasons you don't consider it. I didn't say that. I did not say NVIDIA has high margins. So I don't consider it for that reason. Go watch the segment over again. That's a gross misrepresentation of what I said in that video, but I'll continue on anyways. That's almost like saying you don't want a good looking wife because it's harder to keep her than an ugly one. I agree. If that's what I had said, which I didn't, I think that would be an apt analogy, but that's not what I said in this situation. It's punishing the company for something positive. I could go on with a couple more points, but I'd love to hear your reasoning. No hard feelings, just keep doing your thing. Okay, so let me start from the end there, and then I'll address the other points. You know, the NVIDIA margin thing. I'm saying that NVIDIA has incredibly high margins, which attracts an enormous amount of competition. Now, it's great to have a high margin business if you're confident that the company can maintain those margins. In fact, it's better. The best scenario, okay, let me outline a couple scenarios here where you get the best returns and you get the worst returns. The best scenario is a company that has a low multiple that's going to accelerate revenue growth. So revenue growth is going to increase. Not revenue is going to increase, but revenue rate of growth is going to increase year over year. So you have analysts that say, you know what, this company is going to grow faster than expected. We're moving up our revenue analyst targets. That company also is going to expand margins. Margins are going to go from 15% to 18% to 20%. So you have low valuation starting, you have accelerating revenue growth, and you have expanding margins. Those companies are the best situation. That was like Netflix 2 years ago. It had accelerating revenue growth. They did the password crackdown. All the analysts bumped up their targets for revenue, saying, no, it's not going to be like 8%. It's going to be like 16%. They doubled their revenue targets. Netflix had margin expansion. The operating margins were increased, and analysts raised their operating margin estimates. And it had a low valuation 2 years ago. So you had all the best, every single thing you could look for in a stock was going right for Netflix 2 years ago. And that's where you get the way above average return. The worst situation is where you have a company that already has high revenues, that's already priced into the stock, and those revenues get competed away. So they have high revenues already. They're already priced at a high multiple. It attracts a lot of competition, and they can't maintain the revenue because the competition drives down the price of whatever services or goods they're selling. So their margins actually start to tick downwards. And analysts go, oh no, their margins are ticking downwards. And then even to add on to that bad situation of margins going downwards is the rate of growth not accelerating, but decelerating. Instead of having rates of growth that are 40, 50% year over year, all of a sudden you have rate of growth that are like 5%, 10%. So rate of growth goes down while margins start to compress. That's not a good situation. Now, if you ask yourself right now, what situation is NVIDIA in? Are margins going to go much higher than they are today? Is revenue going to accelerate from today? And is the multiple going to expand from today? I think the answer to all those questions is no, no, and no. Now, I don't know for sure. Well, I do know one of those for sure. Revenue growth is decelerating fast. It's going to decelerate very quickly. So one of those is a negative right there. Revenue growth decelerating. The other one that I'm fairly confident is a prediction I'll make here is that NVIDIA will not be able to keep the same margins they have right now for the next 3 years. You can clip it, you can do whatever. I'll stand by the prediction. I don't think they're going to be able to keep these margins. There's too much capital going into this industry, too much competition, and being able to protect those margins is going to be increasingly difficult. So ultimately, when you say that I said in a video, I don't invest in NVIDIA because it has high margins, and that's one of the reasons I don't consider it, that obviously on the face of it doesn't make sense. Because if you look at the margins of the companies in my portfolio, on average, it's way above the rest of the market. I hold much higher margin companies. There's only a couple that are lower margin, but that's because of their business model. That is Costco. Costco intentionally keeps margins down, which I think makes it easier to protect. But they do something else. They earn money through subscription, right? So no, maybe I didn't express it clearly or explain it adequately, but I love high margin companies. My concern with NVIDIA specifically is that they'll not be able to sustain those margins. That you're starting right now at a very high valuation. You're starting right now at a point where margins are most likely to go down from here, not up, and where revenue's most likely to decelerate. And you're starting at a company that has had an exponential, explosive upside boom and a historically boom and bust industry. So I think, again, all of these facts lead me to believe that this company is not a good investment. It could go up, and many times bad investments go up. So if you just do the thing where you look in the future and you say, oh, well, it went up, it was obviously a good investment. Crypto went up. I don't think crypto has been a good investment. If you go and you buy a lotto ticket and you win $50,000, that went up, you made money doing it. And that doesn't make it a good investment. A good investment, in my opinion, is one where you're making predictable money. So NVIDIA right now, I think, is highly unpredictable of how you're going to get gains out of it over the next 5 years. Again, my opinion on it, you're free to disagree. You point out that NVIDIA has made a lot of gains over the past 10 years. I could list a chart of companies that have done really well over the past 10 years. You know, that is survivorship bias. How do you predict 10 years ago that NVIDIA was going to do what it did? How do you predict 10 years ago that OpenAI was going to make ChatGPT and there's going to be large language models that would cause an influx of a boom that NVIDIA would happen to have the perfect thing for at the right time? Most people at the time were predicting, there's going to be this big boom in chips, but Intel's going to be the leader of it. It's a very difficult industry to get it correct. So again, my overall message here is I look for predictability more than anything else. I want to be able to look at a company and have confidence they'll get good returns over the next 10 years. With NVIDIA, based on the setup right now, I don't have confidence in it. What is your thesis on Canadian Pacific? Why are you investing in them? It's an oligopoly. Basically, the thesis on Canadian Pacific summarized is based on their revenue targets, their CapEx, and their growth. They can grow about 20% free cash flow per year for the next 5 years. And like I just stated, companies that grow over 15% per year almost always make money. They almost always beat the market. So if they grow their free cash flow by 20% per year for the next 5 years, it should be a market beating position, but it's been largely ignored right now. It's been a dead stock for the past year. What would you suggest for someone with a large medical student loan debt around $480,000 at about 6.5% interest rate in terms of repayment plan options, which would be best to also build a large investment portfolio over time? For context, there are two main repayment options. One is a 10-year fixed amount monthly payment, and the other is an income-based repayment plan where after 25 years, the remaining balance is forgiven. On a $350,000 salary, the first option is about $5,400 monthly payment, and the second one is about $2,600 payment monthly. The first you pay for 10 years, and the second for 25 years, albeit a much higher amount over the time period, almost $350,000 difference. Taking into account time value of money and using the excess cash from the second option to invest, which do you think is the best option in your own opinion if the goal is to build wealth over the long term, 10 to 20 years? Yeah, there's a lot of considerations here. You can map out the most mathematically beneficial way to do it. You can look at like the 25 years, if you get it forgiven, and if you invest the difference between what you save on that plan, you might be able to come out with some outline that that's the best option. But also keep in mind, when the remaining balance is forgiven, it's forgiven, but it's acted as though the amount that's forgiven is income. Now think about how much money you might be making in 25 years. I know right now you might feel like, oh, I'll be retired by then. I might not be making as much as I am today. I think with inflation, with salaries going up, and with the fact that you're probably going to work for the next 30 years, and you'll be at like the peak of your career in 25 years, 30 years, you'll have more network and raises and different things that go along with that. I think the amount that you're forgiven then might be a substantial amount. Taxes are probably going to be higher. That could be an enormous tax burden, because if you look at it over those 25 years, the unpaid amount is compounding. So the amount might actually be a huge lump sum that gets forgiven. And again, it's forgiven, but it's as though it's income. You still have to pay taxes on it. So you're only forgiving around around 60, 70% of it, and you still owe 30% of it, which by that time in 25 years with the compounding of the interest rate could be a sizable amount. So that option scares me the most. Waiting 25 years, having that burden on you the whole time, thinking you owe this money that's hanging over you, and finally it's going to be forgiven, but then you owe taxes on the forgiven amount after that time period. It just sounds like the worst option to me. I would not do that option. I would take my big fat doctor, whatever you're going into in medicine, that salary, and I would chunk away at that debt as fast as possible and just get it behind me as fast as possible. I would pay it down aggressively, even beyond the payment plans. And I'd try to do it before you get into the habit of lifestyle creep, lifestyle inflation. Because if you don't pay it off aggressively, what's going to happen is the excess money, you're likely not going to invest as aggressively. Some of it is going to sit in your bank account, some of it you'll invest, but you'll start to have lifestyle inflation where you just start spending a bit more money. That's fine, but I would just take half your salary every year, half your take home, and I would just chunk away at that debt so fast. I'd get it paid off within 5 years. I really would. I'd try to Dave Ramsey it, be super aggressive and pay it off. That's what I would do. That's what my brother did. He went to medical school for a long period of time, and he had a lot of debt by the time he graduated, but he had a good job, had a good salary, and he didn't wait for any payment plans or government options. He took the majority of his salary and paid his loans off in full in a few years. Just 2 or 3 years, got it behind him, done for. He didn't have debt dragging. They're done. They've been done for like 5 or 6 years. Most doctors have debt their whole career. And I think that's a huge mistake. I think overall doctors could be far wealthier in the US than they are because of the way they try to manage their finances. They almost always have tons of debt. They lever up. They buy real estate. They kind of ignore the stock market, and they carry on student debt for years and years and years, allowing it to have compound interest against them. I think it's much better to just take this debt, wipe it out as fast as possible, and then invest aggressively. You can invest while you're wiping out the debt. So I wouldn't say do no investing, but you're going to be getting this big salary. I would be taking some of it to invest in a portfolio and then a huge amount to chunk away at this 480,000. It'll go to 450 and then 400 and then 370 and 340. You'll chunk away at it month after month after month until it's completely gone. And it's really liberating to have that money just freed and not have to worry about it. The wait 25 years, having that compounding against you, knowing that you owe money, I'd hate it. I would not like that. I don't hold any debt like that, no long-term debt. And that might just be like a thing with my family. Nobody in my family likes debt. None of us are indebted. My brother paid off his medical loans very, very quickly, way faster than any payment plan. Good afternoon, Joe. I was listening to all your episodes. You are missing a great amount of episodes and would like to see them numbered again. So many people don't have to cross-reference the content on YouTube and Apple Podcasts. Yeah, I could number the exclusives. I'd have to add up what number I'm on. Maybe I'll just start off on a number and go from there again to make them a little bit more organized. But the reason that I don't put these episodes on Apple Podcasts or YouTube is because these are exclusives. If you're talking about the main episodes on YouTube, I stopped numbering those a while ago. I just don't know if it made a big difference. Yours is like the first feedback I've seen in a while of someone that actually looked at that. Do you ever vote at shareholder meetings of companies you own? If so, do you normally accept board proposals or sometimes side with activist investors? I don't. I just don't feel like I own quite enough to make any type of meaningful difference. I feel like my voice has more of a difference than voting on it. So I'll share my opinions on it, activist investors and what they're doing. But if I cast a vote with like 50 shares of something, there's big funds that really control that. So maybe I will if it's easy to do, but I'm not going to go way out of my way to vote for something when I don't feel like I'm going to actually sway the vote at all. What stocks or industries are you currently researching the most? I've been looking into more food companies. I've been looking into those, and then cybersecurity are the ones that I spent the most on. So Palo Alto Networks, CrowdStrike, I find these ones fascinating. And then I've looked into the credit industry recently. That was one that I went over a little bit. But yeah, I've been bouncing around different industries trying to find companies that I think are true compounding machines, which fit into that criteria. Ones that will have excellent balance sheets, have moats, not just moats, but they're basically monopolies. I want to try to find these companies, and it's difficult to find. I'm trying to search for them, but they're difficult to find. Longtime viewer here. Thank you for the amazing content. Much appreciated. I watched Terry Smith's latest shareholder meeting. Very good watch. I probably enjoyed listening to him and Julian for this similar reason to you, wrong or right. They fully explain their reasoning. I think I've gone over this one before. If you say this year it was slightly different with some justification he gave for the portfolio underperforming, obviously he's going to justify it. I've gone over that where I think Terry Smith has made a series of really bad timed sells that have hurt his performance, and he needs to get back on track. I think he can do it. He'll get back on track. However, most interesting thing was that Terry said he was looking to a bank, at least. Yeah, I think I've answered this one before, gone over a similar question. I think banks now are more service-based than lending-based. They're more based on like credit cards and, digital technology than just lending money. I would be surprised if Terry Smith just invested in a traditional bank that was making all of its money lending money, because he's wrote entire books on that. He's very strongly opposed that publicly. Thoughts on Universal Music Group? It's a high quality compounder. I've only seen you mention it once talking about Spotify. Why is it not on your watch list? It's also Bill Ackman's biggest position. Also wanted to ask in regards to how many companies you really do deep dives. Do you really do deep dives? Of course, additionally to ones in your portfolio. I suppose there's a point to where you have the maximum number of compounders you're currently tracking. I'll do deep dives into different companies all the time, where I'll go into them, open up the earnings reports, read everything I can about them, listen to every podcast that I can about them, and just absorb every YouTube video and just absorb as much info as possible. Watch CEO interviews and, everything I can to try to learn about the company. but I have to be interested in the company. And there's one thing that Charlie Munger said. He said that as you get better at investing, you'll have filters where you'll be able to immediately know like 80% of companies if you're even interested in looking further into them, because you'll have filters that will immediately rule them out. So a lot of people say, oh, why haven't you done a deep dive on this company? It's because I've done a shallow dive. I've looked at a couple surface things and immediately recognized this is not going to be an investment for me. So why spend a week diving deep into a company when I already know that there's no chance I'm investing in it? So what I'm trying to do is get past the shallow dives of companies where, I look at them and I go, wow, this is really good. I like what I see here on a shallow kind of surface level. I want to dive into this one deeper. That's what I look for. And there are some companies like that. MSCI, Airbnb, Uber, those are ones that I on a shallow level, I like them. They have lots of characteristics I like that I find very intriguing that I could see in my portfolio. CrowdStrike, Palo Alto Network, shallow level, I love them. So it intrigues me to do more deep diving into those ones. ASML, love it. Everything I've read so far. So there's ones that I really do like, but there's other ones where people bring them up and I just know within like 10 minutes of looking at it, this isn't an investment for me. I don't like the competitive structure. I don't like the products they sell. It's just not an investment for me. With Universal Music Group, it's been in Bill Ackman's portfolio for a while. I guess it's a good company. I just don't think that there's, maybe I'm wrong on it, but I don't feel like there's as much chance for explosive outperformance with that one. I feel like it's very well understood, and I think that streaming services have more chance of like extreme outperformance. Spotify, Apple with Apple Music, and Amazon. So I'd rather be invested in Spotify because they're the ones that have the connection with the customer, and I feel like that's the strongest position to be in. I know Universal Music Group has better economics, but ultimately, when you have the relationship with the customer, you kind of own you kind of own the situation there. The companies that get circumvented and subjugated are the ones that don't have the relationship with the customer. So, I think Universal Music Group is concerned about the long-term prospect of Spotify getting so big that they can kind of negotiate with a lot more power. They can negotiate and, even win over artists and do different types of things. Another thing is I see value offered. I don't see the value that Universal Music Group offers to artists. I think it's kind of a legacy business that's there because it's always existed, but the marketing, the interface, the connection with customers, the marketing tours and artists and animations and everything, the algorithm to find all of their customers is from Spotify. And I think over time, the economics may shift to reward the company that's doing most of the heavy lifting. How do you contribute to your portfolio? But it's value. Do you just invest in M1 and forget about it? Also, what do you think about diversifiable risks in your portfolio? I'm currently learning about it in college and textbook, and it says you should have 25 stocks to be considered diversified. Yeah, and like no stock greater than like 4 or 5%, right? You're probably learning about like some of the fundamentals. They'll teach you about systematic risk and specific risk. So you can diversify away from specific risks like management, a company making a poor decision. You can diversify away from that by having a whole huge number of holdings. From most of the data I've seen, the majority benefit of diversification starts to really trail down. You get diminishing returns of diversification after around 7 stocks. I have 12. So I feel like I'm relatively diversified against specific risks. I have 12 different companies. They're all weighted around the same, and they're all in very different industries with very different external risks. So a risk that affects one of my companies is unlikely to affect another to a great degree. There's some overlapping risk, but that is systematic risk. That's stuff like, the whole U.S. economy going down the tank, right? If the U.S. economy imploded, that's going to affect everything. But you can't diversify away from that. So I'm diversified, I think, a very good amount based on my portfolio, the holdings, and the external risks that affect these companies specifically. In terms of my deposits, I just put money in. Usually every 2 weeks or every week I'll put some money into the portfolio, and then I'll try to buy companies that I think are the best value at the time. How many hours do you spend researching a company before deciding whether or not to add it to your portfolio? Oh, before I add it, many hours researching a company. And most of them are companies that I've known for like years. I've really looked into it for a long period of time. So a lot of time before adding money to it. Think about it the same way. Peter Lynch mentions this. If you are doing, a lot of people will shop for like a TV or a refrigerator for their house or a car, and they'll do a ton of research on that. They'll read every brand of television. They'll, whether it's LG or Samsung or this or that, and they'll read about the contrast ratio or whatever they're buying. They'll do all this research for it. And then when it comes to a stock, they'll hear a rumor and throw in $5,000 based on that rumor. Does that make sense that the smaller things that are smaller decisions with smaller amounts of money, we should do endless research on, but then when it comes to buying a stock, we should do none? If you don't want to do any research, just buy an ETF. The reason that I invest in individual companies is because I think they have a brighter future than the ETF. I think they'll outperform. And I'm not going to invest $50,000 or $60,000. That's a ton of things I'm buying, a ton of shares I'm buying, and not do adequate research on it. So that's not a guarantee. Not every company I invest in is going to do well, but I definitely increase my chances of making profitable investments by doing a decent amount of research. And I think importantly, doing good research. Not all research is the same. I think if you consume a lot of info and you've studied something, that can be good and bad. If you're consuming bad info, low quality info, if you're getting other people's opinions that are not great on the subject, if you're not doing quality research, then it might lead you to a bad outcome. So if you're surrounding yourself with people that don't share quality research, that aren't quality investors, that don't know what they're doing, and you consume that type of information, I think that's a dangerous situation. So I try to do really well-rounded research from good sources based around fundamentals and just common sense. A lot of the investing I do, I feel like, is just common sense investing. Looking at companies that I have a reasonable expectation they're going to do really well. What do you think about TPL? I don't know about TPL. Let's take a look. I've heard this one before. Texas Pacific Land Corporation. Land resource management company. It's a bit fringe. I guess it's an interesting investment. I haven't looked into it enough to know a really great opinion about it. So that one I'll hold off on my opinion on that one until I do a bit more research on it. Hey, Joseph, would you mind separating the Q&A and non-Q&A exclusive videos? Make it a lot easier to find content we're looking for, and you also get to list them as two separate features on Patreon, a win-win. Maybe, some of them I combined together. I think it's nice to have some variety, but I can try to separate them in future videos. Reposted from April. Hi, Joseph. In your video today about CRM, you were very clear your investment thesis for buying into CRM. What I think wasn't addressed, unless I missed it, was out of all the stocks they say are equally as good, what was the thought process of choosing CRM over the other stocks? What I think wasn't addressed, unless I missed it, was out of all the stocks they say are equally as good, what was the thought process on choosing CRM over the other stocks? I don't think they're equally as good. So when I have that's the hard part, is when I have a list of companies I think are all really good, and I'm trying to determine which one I think is best. There's usually like a few little things that tip the scales. So for Salesforce, I wanted to add in another quality compounding growth company that had expanding margins and predictable revenue growth, equating to higher and higher amounts of free cash flow growth. And Salesforce fit that story really well. It's a company that's trying to grow margins, trying to mature, cut down on expenses. They're not doing as many acquisitions. They have a very good, diversified, large concentration of software in key industries. They're competitively advantaged. So they have all these different characteristics I like. And then I was comparing it to other companies I don't own, like Adobe. When I looked at Salesforce and Adobe, what tipped the scales to Salesforce is I simply thought that Adobe was at greater risk of having disruption through AI and image and video editing than Salesforce's risks. I don't think there's as many things that are going to circumvent or replace Salesforce as potentially Adobe. Could be wrong, but Adobe has their Creative Cloud, and I know both of them are expensive. Salesforce is expensive and Adobe is, but I think Adobe has really hit the upper limits of how much they're charging their their customers, their non-business customers, right? Direct to consumer customers. It's like $50 a month for Adobe Creative Cloud. And even if you're making money and you're doing well and you have a good job, that's a lot of money every month for something where there are alternatives to Adobe. Salesforce, on the other hand, is attached to businesses. And businesses usually can justify incremental increases in price of their cost of goods and their things that run their business. Because, you know, when you're running a company, it's like not directly coming out of anyone's pocket. It's kind of just in the mix. So it doesn't feel like it's like as direct of a price increase. When Salesforce increases their price, a company will look over that. They might gripe about it, but ultimately, usually they'll pay it. And it, you know, it has a lot of switching costs to move. And I don't think most companies make stuff as good. With Adobe, I feel like they've really just charged a lot. So I feel like there's some upper limits with pricing power. And I feel like with Adobe, there's a higher chance of disruption. Now, having said that, Adobe is an incredibly good company, and I'd rather have Adobe in my portfolio than like 99% of other companies. So I'm not down talking Adobe. I still think it's fantastic. It's a top tier company, but I just like Salesforce slightly better for specific reasons. And basically with Salesforce, I think the durability of the company is more predictable. I'm going to end this one there. That'll be all for now, but I'll have more AMAs, more exclusives out next week. It's going to be a busy week. That's all for now.